The Securities Black Market. I mean, it sounds like something straight out of a spy thriller, doesn't it? But it is very, very real. Today, we're going to pull back the curtain on this hidden corner of Wall Street, a place where billions of dollars change hands in, you guessed it, total secrecy. $154.3 million. Now, that is a huge number. And no, it is not a lottery jackpot. It's actually a fine. It's the price two of the world's biggest banks had to pay for breaking the rules in this very secret market. Yep, that massive penalty, that was handed down to Barclays and Credit Suisse back in 2016. And this quote from the New York Attorney General at the time, well, it really tells you everything you need to know about the stakes. They were fined because they were misleading investors about what was really going on inside their private trading venues, which have the very ominous name dark pools. So let's get right into it. What exactly is this secret market? It's time to shine a light on how it all works, and maybe more importantly, why it even exists in the first place. And just so you know, our guide for this whole deep dive is some really fantastic research that was published in the Vanderbilt Law Review. It does a great job breaking down the nuts and bolts of this hidden financial world. Okay, so what is a dark pool? Here's the easiest way to think about it. It's basically a private stock market. You know how the New York Stock Exchange is all out in the open? Every trade, every price, it's public. Traders call that a lit market. Well, dark pools are the opposite. They're hidden. And they exist so the really big players can trade huge amounts of stock completely anonymously, without anyone else knowing. Now, I know what you're probably thinking. Why would anyone want to trade in secret? It sounds kind of shady, right? But believe it or not, there are some pretty compelling reasons behind it. See, the logic is actually pretty fascinating when you dig in. We're talking about massive institutions here, like the pension funds that manage retirement money. They need that anonymity to keep their competitors from figuring out their next move. It protects their strategies, sure, but the biggest reason, the most important one, is to avoid a really expensive problem called market impact. And this chart really lays it all out. Side by side, in a public, lit market, everything is happening in real time for everyone to see. But in a dark pool, it's private and the reporting is delayed. And that key difference is everything when it comes to understanding this market impact thing. So let's break that down. Imagine a giant pension fund wants to buy 1 million shares of a company. If they place that order on the public market, every other trader in the world sees it. And what happens? The price instantly shoots up before they can even finish their purchase. That little price move could cost their investors millions of extra dollars. A dark pool, on the other hand, is like making a secret backroom deal. They can buy all 1 million shares at once, in private, avoiding that huge price swing. Okay, but here's the catch, and it is a big one. That's secrecy, the very thing that makes these dark pools so attractive. Well, it also makes them the perfect hunting ground for predators. The same darkness that's meant to protect the big fish can also hide the sharks that are looking to feed on them. So let's ask the obvious question. If you've got this dark, murky water, who are the sharks lurking in there? Well, the main predators we're talking about are a certain kind of high-frequency trader, or HFT. These are firms with supercomputers and insanely fast algorithms that let them trade in microseconds. And when they get into a dark pool, they're not just trading. They're actively hunting for those huge hidden orders from the institutional investors. And the way they hunt is pretty wild. It's a strategy called pinging. The HFT firm sends out thousands of tiny, super fast orders into the dark pool. It's like a submarine sonar, just pinging away, looking for something big. When one of those pings gets a response, bam, they found a hidden order. The HFT's computers then instantly race over to the public market, buy that same stock, and turn around and sell it to the original buyer in the dark pool for a slightly higher price. It's a high-tech version of front-running, and it's extremely profitable. And you know, it's not just about these outside sharks. The very structure of these pools is full of potential problems. Remember that huge fine we mentioned? The bank running the dark pool has a massive conflict of interest. What's to stop them from favoring their own trades? On top of that, traders can't see what everyone else is doing, so they might miss better deals. Meanwhile, the operator running the pool, they can see everything. It's a huge information imbalance. So you have to wonder, where are the regulators in all of this? Well, it's not like these problems have gone completely unnoticed, but the story of how we got here is complicated. It's a classic case of good intentions leading to some pretty serious unintended consequences. So, how did we get a system that seems built for secrecy? This timeline lays it out pretty clearly. It actually started with a really good idea. Let's make the markets more efficient. But then, in 1998, a rule called Regulation ATS created an accidental loophole. It allowed these alternative trading systems to operate with way fewer rules than the public exchanges. And just like that, the modern dark pool was born. It really wasn't until after the 2008 financial crisis that regulators started taking a much harder look at these hidden corners of the market. And what they found was a whole universe. The main thing to get here is that dark pool isn't just one thing. They're not all created equal. Some are run by big banks, some are independent, some trade constantly, others only at specific times. And every single one of those different setups comes with its own unique set of opportunities and, of course, its own set of risks. So you'd think the regulators would have jumped all over this, right? But here's the really surprising part. The Dodd-Frank Act, that massive piece of financial reform that was supposed to fix everything after 2008, it barely even touched on dark pools. They were largely left alone, which created this huge regulatory blind spot. And this is where that Vanderbilt Law Review article comes in with a really clever idea. Instead of trying to ban dark pools, it proposes creating a rating system. Think of it like the ABC health grades you see in restaurant windows. It would give investors a simple, clear way to see which dark pools are fair and effective, forcing them to compete on quality, not just on secrecy. So after all that, where does this leave us? Well, it's pretty clear that what happens in the dark doesn't stay in the dark. It spills out and has real-world consequences, creating this fundamental tension right at the heart of our financial markets. This is the core of the whole debate. On one side, you've got a legitimate need for secrecy to help big investors execute trades efficiently. On the other side, you have an absolute need for fairness and transparency to protect everyone from being cheated. It's a serious balancing act. And let's be really clear here. This is not just some abstract Wall Street game. Those large investors we keep talking about, they're often the pension funds and mutual funds that are managing our retirement accounts and our savings. So when they get a bad deal because of predatory trading, it's not some faceless institution that gets hurt. It's us. It's everyday people. The entire market is really at stake. Which leaves us with one last critical question to think about. We live in an age that demands transparency and instant information. So in that world, is it even possible for a market to operate in the dark and still be truly fair? That's the challenge that traders, banks, and regulators are all still grappling with today.